We're going to make you the host. Just give me a second. Yeah, please, over to you.
Thank you, Misha. Thank you for the wonderful introduction. So, before I start, I just joined the call when the last speaker was speaking, and I think some of the topics that I had prepared to cover, I think, has already been discussed. So, if you could give me a little, brief about what was discussed in the last session, so I can modulate my session accordingly.
Uh,
Misha, you're not audible. Sorry.
Can you hear me now?
Yeah. Yes.
Yeah, so it was on climate mitigation, giving an overview of the various aspects like the key sectors there, how is the carbon market working, but that was only very superficial. So I would suggest that it's okay if you want to go ahead and uh, present your session as planned. So
Okay. Sure. Sure. So I hope you all are able to see my screen now.
yes.
Yeah. Okay. So I'll be speaking on carbon accounting. So it will be a mix of carbon footprint basics, uh, and also the carbon market basics. So as you've already mentioned that there was some discussion on carbon market, so I hope the basics have already been covered. However, I'll go through them again throughout the presentation. So first thing first, I think the first question that we need to answer, or I would like to start with a quote actually, is what gets measured gets managed. So it's a very old management quote that if you want to manage anything, it has to be measured first. Then only we know what we're working on, what are our milestones, how to set those milestones, and how to achieve them or how to track them. So all of that can be done only when we're able to measure something, and then only we can set goals and then track our achievements with respect to that goal. Now, the next question is why do we need to manage carbon? So why do we need to manage carbon? So the answer for that is because it is a greenhouse gas. But how does that impact? How does carbon or carbon dioxide being a greenhouse gas impact us, or why do we need to manage that because it is a greenhouse gas? So GHGs are basically GHGs or greenhouse gases are basically necessary evils because they are necessary to maintain an ambient temperature on Earth, because of which life is possible on Earth. And they are also evil because an excess of it causes global warming and climate change. So I think by this time we all are aware about what is climate change, but here is a definition that is more scientifically sound. This definition is by World Meteorological Organization. So they define climate change as a statistically significant variation in either the mean state of the climate or in its variability persisting for an extended period. Now, how do you even define climate? So there are various variables like maybe the precipitation rate, the humidity, the temperature. So there are multiple climatic factors or climatic variables that you can take, and you can track them. And if you have a statistically significant variation in those, which might be for a short period, or you know so there could be a difference, there could be a shift in the mean. Let's say the mean temperature of India throughout a year uh, changes from 25 degree to 26 degrees Celsius. uh, that could be also a sign of climate change. And if that change persists for a longer period, climate change would also be evident if the pattern of changing climate, because or changing weather, you can say. Climate obviously is a term used to uh, used to address weather over a long period of time. So if the change in weather in a particular geography or particular region is not is not similar over period over years or over period of time, so that is what this part of or in its variability takes us to. And if these changes persist for an extended period of time, then we can say that we are seeing our climate change is real. Now, how do we control climate change? By controlling the factors which causes it, that is controlling or limiting our GHG emission. So I think just when I joined the session, there was there was one of the questions from that was being answered, that how do we draw a line between climate change and development. So in reality, there is no real line, or there is no real stage where you can decide that there should not be any further development and we should only concentrate on climate change. That's not possible. That's why it's not about cutting your GHG emissions directly to zero. It's about controlling or limiting. Nobody is telling you that if you're buying 10 clothes today per year, you suddenly stop buying clothes from next year and make it zero. No, that's not what anybody is saying. What all of us are saying, or what all the scientific indications are taking us to, is to limit your GHG emission. So instead of that 10, maybe you could purchase 5, and for that 5 you pay for whatever cost, whatever climate cost or social cost or environmental cost that product is also creating. So we'll come to that session, come to those things at the end if I have time. I have not included them in the presentation, but if anybody wants to discuss on social cost and environmental cost, I'll be happy to discuss that at the end. Now, hence it is important to understand what are the sources of GHG emission, how to limit these emissions, when to take these limiting actions, and whether the actions make financial sense or not. And if those are not making financial sense, then what are the options that we have? Now, next is how to measure, the carbon emissions. So we said carbon emissions, but essentially there are 6 to 7 gases which are altogether addressed as carbon emissions. So in Kyoto Protocol, so as you already have gone through a little bit of it, there were 6 gases which are defined as greenhouse gases. There are CO2, N2O, then CH4, SF6, PFCs, NFCs, all of that. There are 6 to 7. I think there are 7, and there was a revision, and now in some of the literature there are 6 gases that are considered. In some literature there are 7. So GHG footprint and inventory, these two terms are most often used interchangeably, but these are not interchangeable terms. These are very different terms if you understand it in a very detailed manner. Footprint is basically the amount of calculation of the amount of carbon dioxide or carbon dioxide equivalent GHG gases, I should have written, released into the atmosphere as a result of the activities of a particular individual, organization, or country. Whereas inventory, if you see, inventory is mapping of the sources of these emissions. So whenever someone tells you that I want to prepare a GHG inventory, so that report is not only having the the calculation of the amount of CO2 or GHG gases you have emitted, but also that report should also have the mapping of the sources. What are the sources from which you are emitting these emissions or these gases, and how to limit or how you track those sources. Now, in preparing a carbon footprint or carbon inventory report, there are mainly 2 standards worldwide that people follow. One is a GHG protocol, greenhouse gas protocol. The other is ISO 14064. Now you can see on top of this image, there are name of these 7 gases which were recognized as global greenhouse gases in Kyoto Protocol. And the carbon footprint or carbon inventory report will generally have is generally divided into 3 scopes of calculation: scope 1, scope 2, and scope 3. Scope 1 is called direct emissions. So direct emissions are those emissions or those emission sources which are controlled by the company or the organization for whom you are preparing this report, and these sources are also present within the company boundary. So whenever you are preparing this report, there are certain steps that you have to follow. If you go through the GHG protocol or ISO 14064 document, you will see they have defined all these steps. So one of the steps is to form the organizational boundary. So these emission sources, scope 1 emission sources, would be present within the organizational boundary, and these sources would be directly controlled and owned by the company itself. Next is scope 2. So scope 2 is indirect emissions from purchased energy. That is energy, any energy that the company or the organization or maybe the individual for whom you're creating this report is purchasing from outside. So in case of India, you will generally see that as electricity, but in case you go to European countries or Canada or countries which are located in a colder climatic region, so they also purchase heat. So their grid also provides them heat as one of the form of energy, because they need constant heating so that they can maintain ambient temperature in their in their houses, in their buildings, in their factories and all that. So emissions related to these energy sources that are purchased from outside your organization boundary will go into scope 2. Now scope 3 is all those emission sources which are outside your company's boundary, but these emissions can be attributed to your company's activity or to your organization's activity. Let's say my employees are traveling from point A to point B to have a meeting. So if you see, that aircraft is not controlled by me, that aircraft is not my company's vehicle, it's not owned by my company, neither it is within my company's boundary, neither am I purchasing that aircraft or purchasing that whole flight for me. But if the aircraft, let's say in that trip, emits 1,000 tons of carbon dioxide, and there are 1,000 flyers in that aircraft for that particular trip, then for every flyer each flyer or each passenger there is responsible for 1 ton of CO2 emission. Now if you do scope 3 calculation and include those in your footprint, that means your company is responsible for 2 tons of emission in that particular trip. So like that, the scope 3 emissions are indirect sources present outside of your boundary and not under your ownership or your control. So these are majorly divided into 2 halves again. One is upstream activities, one is downstream activities. Upstream activities are those activities which happen in the value chain before the goods or services enter into your company's boundary. Downstream activities are those activities which are done after the goods and exit from your after goods or maybe finished product exits from your factories or from your companies. So there are various things that could be included. Some of them are also included in this picture, like processed products, outsourced activities, renting or leasing vehicles, waste management, business trips. So if you go through the GHG protocol or ISO 14064, they have given a list of activities that should be included if you are doing if you're doing scope 3 calculation. Now, is it possible for any organization to emit zero GHG or zero greenhouse gas, 0 tons of greenhouse gases? The answer is no. And even if yes, would it make financial sense? Let's say the only greenhouse gas emission my company has is because of the purchased electricity. So in that case, what I can do is maybe I can put up a solar power plant or a wind. I can purchase a wind power plant and then wheel that energy to my premises. That I can do. But does it really happen that you have only purchased electricity as your emission source? No, definitely not. There will be some other. There will be definitely scope 3 emissions associated. There will be scope 1 emissions. So scope 1 emissions would be like maybe whenever you are not having electricity, you need to use a DG set, so you will be using generators. You would be having your ACs working in your office premises, so they have certain gases which are greenhouse gases. You have refrigerators. You use stationaries like paper, pen, pencil, all of that. You purchase products which are manufactured by other companies, so those are also scope 3 emissions. So literally, if you see, there is no company which can emit zero GHG. But then most of the companies that you're seeing right now, or you must be hearing in the climate in the market of climate change, they have carbon neutrality goals, or uh, net zero emission goals. So how do you achieve them? If it is not possible for any company to achieve zero emissions, or it is not financially feasible after a point of time to achieve zero emissions, how do you achieve them? That's when the emission trading markets come into picture, because they help you economize the cost of reducing emission and achieving carbon neutrality. So we'll see how that happens. So I have just in a picture of two graphs in front of me. I'm sorry, I don't have in a pen and paper to explain this, but I'll try to explain as much as I can. So there is something called MSC. MSC means marginalized abatement cost, and these curves, that the two curves that you see are called marginalized abatement cost curve. So it simply means that for every additional unit of emission reduction, what is the cost you need? Let's say, for a basic example I'll give, let's say my company's emissions are 10 tons per year, and I have to achieve carbon neutrality. Now that means from 10 I'll be reaching 9, and then 8, and then 7, then 6, 5, 4, 3, 2, 1, then 0. It cannot be like from 10 you're directly reaching 0, right? So from 10 to 9, to reduce that 1 ton of emission, you'll do certain activities that reduces that ton of emission. Now that activity will have certain cost. That cost, you let's say that is X, which you incur to reduce that emission, is called the marginal abatement cost for your first ton of emission reduction. Now when you go on closer to 0, you'll see that your marginal abatement cost increases for each ton, because at the beginning what you will do is you'll find easier ways of reducing emission, you'll find cost effective ways of emission reduction. But when you slowly progress towards 0, you'll see that the cost,
Carbon emission. Okay.
yeah, please mute yourselves. Okay, thank you. So this marginal abatement cost increases as you go through your emission reduction journey. When you start, it is less. When you proceed towards the neutrality mark, the cost increases. Now every company will reach a point after which that cost is not financially viable for them. Okay, let's say for me, for my company, the cost could be $50. For your company, the cost could be $35. So for your company, beyond $35, it doesn't make any financial sense to reduce your emissions any further. For my company, it could be beyond $50. It doesn't make any sense to reduce my emissions. So it is a very relative term. It differs from companies to companies. It differs from sectors to sectors. Mainly, it differs from sectors to sectors. So let's say there is cement sector, there is transport sector, there is energy production sector. So all of them have different abatement cost curves. All of them have different points where they can say that beyond this, it is not financially feasible for us. So then what happens? Let's say maybe I reach that point when when I have just reduced $3 tons. So I have still 7 tons left, and maybe you have reached that point when you have reached 5. You have reached 3. You have only 3 tons left to neutralize. So then how to and both of us, let's say both of our targets is to reach a level of 5. So let's see this graph again, and then let's understand. So let's see So this so this R star that you see, okay, so this is the point where so this is the point where each of the companies have to reach to each of the companies have to reach according to the targets they have been given, R star or are required, sorry, are required. So what will happen is the curve that you see is more steep for Sweden. So here there are two countries those are being compared. So the cost is more steep for Sweden. So what Sweden would say is, beyond this point C here, it is not feasible for me to reduce my emissions further. And here Germany, they are required to reduce emissions till 3, but you see they can go up. For them the cost is not that high, see this P, price P, okay. So they have already achieved this much, they have already achieved their target, and maybe they have room for some excess, okay. Now what will happen is, Sweden would say, Sweden would ask Germany, can you reduce emissions for me, and I'll pay you for that. So what Germany would do, Germany would further reduce its emission. It will come to this stage, R star, and this triangle that you're seeing, that is shaded in horizontal green lines, is the additional cost, or maybe cost that Germany has incurred to reduce these emissions further from R required to R star. And these will be then sold to Sweden. So how these, in this case, both of the companies or both the countries are benefiting is, Sweden will purchase, let's say, for Sweden to move from R star to R required, it would have taken $100, and for Germany it took only $50 to move from R required to R star. Okay, so in a previous example, you can see that Germany was at 3. They have both of their target was 5. Sweden is at 7. Germany is at 3. Now Germany has reduced 2 extra tons. Sweden is falling back by 2 extra tons. Germany would sell its 2 extra tons to Sweden. Okay, let's say the cost for Germany to reduce these 2 extra tons was $50. For Sweden, it would be $100. What would then happen is, Germany would say, I would sell these tons to you if you pay me $75 per ton, or maybe $70 for both the for 2 tons. Sweden would say, okay, I can purchase these tons, because anyway the cost, if I do that emission reduction, the cost for me is 100 tons. So Sweden is at a profit of 25 tons because they are saving $25, because they are saving $25 in this process. And Germany is getting a profit of $25 because because the cost for them to reduce emission is lower. So that's it. That is the total economics of emission trading market. According to emission trading market, the emission reduction should happen at those places where the cost is lesser, and these benefits can then be distributed among those or to those for whom the cost is higher. In this way, companies whose cost is lesser, whose emission reduction cost is lesser, or countries whose emission reduction cost is lesser, they can earn extra profits by trading these credits. And countries for whom the cost of emission reduction is higher, they can reduce their emission at a marginalized price, or at a lesser cost, by paying for these emission reductions. So I mean, if anyone of you has doubts and or still are not understood this, we can surely discuss this at the end. So this is a simple sorry, this is a simple chart of how the value chain of the carbon offset trading works. So these are there are organizations looking to go carbon neutral. They reduce CO2 emissions, but there are still some unavoidable emission that cannot be avoided. So to To neutralize these unavoidable emissions, they purchase carbon offsets. There are offset projects like wind project or the solar project or maybe waste management project. There are 100 types of projects that could be there. They reduce or avoid emission and verify these emission reductions or avoidance as carbon offsets, and then trade this in the market. Now, this is cancel credit. Now, cancel credit, what happens is, let's say, most of you maybe might have dealt with stock markets. If you buy a stock or if you buy a bond, you need to have a demat account in which you can hold those instruments. Like similarly here, as these are tradable instruments, you need to have a registry account. So there are multiple registries, so you can open a registry account, and then through that account you can purchase and sell credits or trade in credits. Now, whenever a company is looking for credit to reduce their emission, they cannot simply buy credit. They have to buy and cancel the credit. Canceling credit means you have to give a reason to the registry that you are canceling this credit or retiring that credit for using towards your carbon offset or carbon neutrality goal. So what happens is, in the background, in the system, that credit is retired and that credit is removed from the circulation, removed from the system, removed from the registry system. That same credit, it will have a specific a serial number. So credit with that serial number will not be available for purchase for any other market participant. So that's what it means, credit cancellation of credit or retirement of credit. Now, how did it all start? So there are three main events that I consider are the milestones of the carbon market. First is the UNFCCC, United Nations Framework Convention on Climate Change. It was signed during the Rio Earth Summit 1992, and this entered into force on 21st March 1994. Now, under UNFCCC, there are various things that were accepted, recognized, and understood. So some of the ones that stand out are the common but differentiated responsibilities, and also the fact that the developed countries were responsible for the climate change that we're seeing now, because they have they had used all the resources they had at their disposal for the development of their countries, of their citizens. And as a result of the pollution, as a result of the GHG emission, because of those resource exploitation, the whole world is was seeing the signs of climate change. But then it cannot be said that as climate change is happening, everyone should stop developing or everyone should stop utilizing their resources, because that would be an injustice for developing countries. They were just starting to get access to those resources and provide basic amenities to their citizens. That's why this term of common but differentiated responsibilities came in picture. So under that, okay, so I'll go by sequence. So the next event was Kyoto Protocol. So Kyoto Protocol was nothing but the operationalization of UNFCCC. Now, under UNFCCC, there were certain targets that are selected. But how do we achieve those targets? How do we, hold responsible or hold accountable the responsible parties? So for all of that, whatever framework and whatever, if you all could mute yourself, please. Hello. Yeah, thank you.
I think
So
everybody's muted already. Go on, Sachin.
yeah, so Kyoto Protocol basically operationalized the UNFCCC. Now, in that came common but differentiated responsibility. That means controlling climate change was a common responsibility, but it is a differentiated one because it laid more emphasis on those countries which were responsible for this global climate change, and it obligated them to act in a much more significant manner compared to other countries. So countries all around the world were divided into two segments, basically, you can say. In Kyoto Protocol, you can see there is one annexure called Annexure A, where developed and economies in transition, these are the two categories of countries which were included in that. These countries were assigned emission reduction targets, and these targets were supposed to be met through market-based instruments. Market-based instruments are carbon offsets. So for carbon offset, there were two things, I think, CDM, clean development mechanism, and there are joint implementation where developed countries could collaborate with each other and reduce emission and trade those emission reductions or those offsets. So that is the point when market-based instruments came into picture in Kyoto Protocol. And the next big thing happened was the Paris Agreement, where I think all of you must have heard about the 2 degrees Celsius target, and also to emphasize on preferably limiting the temperature rise to 1.5 degrees Celsius target compared to the pre-industrial levels. Now, how do we get carbon offsets? So all this about history and everything is fine, but how do you get carbon offsets? But you can get carbon offset by registering your project with a carbon offset mechanism or a registry. So what are the available mechanisms? One is CDM, that is Clean Development Mechanism. It is directly under UNFCCC. So there are a couple of other private mechanisms or registries that function around the world, which can issue you carbon credits, and these also function on the basis of the basic framework that was laid down by CDM itself. So some of these are VCS, GS, GCC. VCS is Voluntary Carbon Standard, GS is Gold Standard, and GCC is Global Carbon Council. Now, what process do you need to follow to get your carbon offsets? So there are basically 6 steps that we need to follow. First is the project design. In this case, what happens is, in case of an engineering project, you have a detailed project report. In case of an environmental project, you might have an environmental impact assessment report. Similarly, in case of a carbon offset project, you need to prepare a document called the project design document. So this document will basically have all the basic details about the project, all the assumptions, all the estimations, even the let's say I'm going to install a solar power plant. Now, in that solar power plant, how many units of energy it is going to produce in a year, that estimation will be there, and that much of electricity is responsible for how much of emission avoidance. That calculation is also there in the project design document. So that basically called the assumed emission reduction calculations. Now these calculations, once you do, these has to be third party verified. So these organizations, CDM, VCS, GS, GCC, they all have third party auditors, accredited third party auditors. In CDM, they are also called designated operational entity. So you have to appoint one of the third party auditors, who is certified by these organizations with whom you want to register your project, and they would validate your project design document that you created in the first step, and give their validation report. Now, once that validation report is accepted by the executive bodies of one of these organizations, your project will be then registered. Now, after registration, what happens is your project gets a permit. You can say that, let's say your project can issue credits for next 7 years or for 7 years. Now, you don't get credit only on the basis of the estimation or assumption that you have made on the PDD. You get credits on the basis of the actual emission reduction your project has created. Now, how do you measure that actual emission reduction? So for that, the next step is monitoring. In monitoring, what happens? For every kind of project, they have defined what data needs to be monitored throughout the project life cycle. Now, if it is a solar project, the basic data is the energy generation from that solar power project. Now, in the monitoring phase, what I do is I take those monitoring data from the project and create a monitoring report, which is in some way similar to the PDD, but PDD wasn't just an assumption or estimation. Here it is the actual thing that you're calculating. So let's say if I'm going to issue my credits for 1 year, then I'll take monitoring data of 1 year. I'll calculate for that 1 year or for that data that I have, how much emission reduction has actually happened. And then these calculations, these monitoring report has to be given to another third-party auditor. So you'll have to appoint a third-party auditor again, and they will then verify your monitoring report. And once they verify and submit their verification report to the executive bodies of these standards or mechanisms, your credits are ready to be issued. Now, after that, there is a certain issuance fee that you have to pay, and then your credits are issued. So I've already spoken about registry accounts. So your credits will be issued in your registry account, and then you are ready to trade those credits. So this is basically all about carbon credit trading, and I know that I could have included much more things. So what I want to further speak on is the type of projects that can get carbon credits. So there are actually numerous type of projects. The list is quite exhaustive, but some of them that I can mention is renewable energy projects, projects like electric vehicles, waste management projects where there are projects like composting projects, municipal solid waste treatment project, landfill gas to energy project, biogas projects, bio CNG projects, biodiesel projects, conversion of agricultural waste, or you can say agricultural leftovers like paddy straw into pellets. So these pellets can be used as energy sources in boilers, cement kilns, all of these. So these are waste management projects. Then there are nature-based solution projects where you can where there could be afforestation or reforestation project, where there could be REDD+ project. REDD+ project is reduction of emission from avoidance from degradation or deforestation. That means you're basically improving the carbon capture capacity of a forest, not really you're doing reforestation, afforestation, but basically maintaining and improving the carbon capture capacity. And then there are mangrove restoration project, there are peatland and wetland restoration projects, there are soil carbon projects, there are biochar projects, there are industrial fugitive emission reduction projects, energy efficiency projects like improving energy efficiency in case of industries, like you can your lighting infrastructure, your boilers, your chillers, your HVAC system. There are domestic energy efficiency projects also, where you can distribute LED lights in households that replaces CFL bulbs. There are cook stove projects where you distribute clean or efficient cook stoves in rural marginalized societies or areas where they are still using non renewable forest biomass, and using the three stone chula or traditional chulas or traditional cook stoves to cook for cooking, and that emits a lot of soot, carbon dioxide, and it's also not efficient. So when you distribute an efficient cook stove, I don't say that it doesn't emit carbon dioxide. It does emit carbon dioxide, but it reduces the emission intensity. So for the same amount of cooking, this will emit less GHGs compared to traditional cook stoves. So there are safe drinking water projects where you distribute filters or make safe drinking water accessible for communities where they're still using non-renewable forest biomass to boil and purify the water. There are upstream emission reduction projects. So in case of oil and gas industry, in the upstream sector, where there is exploration and extraction of oil, there are a couple of projects that can be implemented which reduces the emission intensity there. So the list is actually quite extensive. There could be various other kind of projects where emission reductions or carbon credits can be achieved. These are some of the examples that I could give and that I could recollect. So that's it from my end. I'm ready to take any questions if you have. Thank you.
Thank you, Sachin, for the interesting presentation. Now I'll request all the participants to please put in their questions or comments in the chat box. Meanwhile, Sachin, I have a few questions for you. So what is the minimum amount that can be traded in the carbon market? Like what is the unit, I guess, is tons of carbon dioxide reduced.
Yeah.
So what is the minimum quantity that you can trade, and what is the unit price for a ton of carbon dioxide? And like in the Paris Agreement now, there are some provisions which were being discussed to, if I understand correctly, the carbon market is being reframed. So has that process gone ahead, or are those discussions still ongoing?
Yeah. So I'll answer one by one all of the questions. So yes, one carbon offset is equal to 1 ton of CO2 equivalent GHG emission. So actually there is no minimum limit to issue your carbon credits or minimum size to your project. But as you have seen that there is a certain process that needs to be followed, and there are multiple organizations involved in this journey. You need to have a consultant who has the knowledge of that whole process. You need to appoint a third-party auditor. So there is certain cost involved. Let's say you have to pay $10,000 for the validation of your project and $10,000 each time for monitoring and verifying your project. That means your total, let's say, uh, that means for the first time you issue your credits, if you don't get at least $20,000 by selling those credits, it is not going to be a financially, feasible or financially attractive proposition for any company to go ahead with that. So that's why you need to see that you're getting enough number of credits from a project so that you can cover your cost of this validation verification and then earn some profit. Obviously, the intention is to earn profit or earn additional revenues for your project. Now, the next question: what is the cost of a carbon credit? So that answer, it's a quite interesting question, but I don't have a definitive answer for that, because the reason is uh, there is particularly no exchange of carbon offsets. So there is no worldwide exchange. So 95 to 99% of the carbon offsets traded worldwide, which is a $1 billion industry now, is done through OTC trading. OTC means over the counter. That means you go in the market, you research and find out which are the companies who wants to buy these credits, and then you negotiate a price with them and sell it, right? So there will be,
Still has to direct coordinate with the other organizations. There is no platform for the system.
there is as such no exchange platform, Misha. So there are platforms where you can list your credits, where buyers can list themselves to purchase credits. So those platforms basically act as matchmaking platform. These are not exchanges. Like BSE or NSE, you see that for every stock there is a particular price. That price is universal. There nobody can contest that price. And most of the times, if you see, if a same company is if a same company is present across two different exchanges, the price would be more of similar at any point of time. So there is no exchange. There are matchmaking platforms. So there also what happens is you go list your project, you mention your expectation yourself that I want to sell my credits at these price, and then if that matches the buyer's expectation, buyer's budget, they purchase it. Okay, but 99% of the trade happens on an OTC basis, because I'll say there are various reasons. So carbon offset, the pricing, there are various variables to the pricing. One is the mechanisms that I've shown: CDM, VCS, gold standard, and GCC, all of that. So all of these have different credibility in the market. So if a similar kind of project is registered with these three different registries, they will get different prices, because the ease of movement of credit from one registry to other in different across these registries are different, and the acceptability of the credits from these registries are also different in the market. The next is type of project. So as I've shown the marginal abatement cost curve. Let's say my if I have a solar power project, my marginal abatement cost curve is lesser, because I'm not because carbon offset price is is not my primary revenue. My primary revenue comes from sale of energy. But at the same time, if you see the distribution of a cook stove or distribution of a safe drinking water project, so for them the primary revenue is nothing but the carbon offset sale. So for them the cost is higher. So the cost of abatement is also something that is looked at, and then comes the country in which the project is located. So the market sentiment or the market has been designed and built in such a way that the more challenging the geography in which you implement your project. Let's say I have a 5 megawatt project in India and I have a 5 megawatt project in Syria. So realizing a 5 megawatt project in Syria is too difficult than implementing the same project in India. So from the investors point of view, or from the buyer's point of view, if you see, they see that if I purchase and support this 5 megawatt project in Syria, it can create additional impact in the market, or to the environment, rather than going for India, because anybody needs good sense of mind would anyway invest in a renewable project in India, because in India it's a profitable scenario. The next is the vintage. So as you have seen that when I do monitoring and verification, we do it for a particular period of time, let's say for 2020 or 2021 or 2019. So these period of time for which I monitor my project are also kind of attached as a timestamp to the credits. So credits have vintage. So the recent the vintage, the higher the price, the older the vintage, the lesser the price. So these are some of the variables that are associated with pricing of carbon credit. That's why it's difficult to put a price, but I can give you a broad range that currently in the market you can get carbon credits somewhere in the range starting from $3 to $5, and it can go up till $35-40. And in recent news, I don't know if some of you have followed, carbon credits are also being on the basis of carbon credit, there are also blockchains and cryptocurrencies that have come up. So carbon credits are the asset on which these cryptocurrencies are built, and one of the carbon credit supported NFT was sold at I think $70,000. That is the highest price that any carbon credit has been sold at.
What is the updated scenario on Paris Agreement for this?
Yeah. So yes, there is action on Paris Agreement. The market is supposed to change. The rules and regulations are supposed to change. So there has been a positive outcome in recent COP, that is Conference of Parties, that happened in Glasgow, COP26. But most of the operationalizing aspects of the decisions that were taken are still to be realized, are still to be implemented on ground. I think the next step would be for every country to come out with a clear-cut NDC for the next 5 years, and then define which kind of projects which kind of projects or which kind of emission reduction they are going to account under their own NDC, and which kind of emission reduction they are going to allow to be traded in the global voluntary carbon market. So these decisions are yet to be clarified from each of the countries and even at a international level.
Thanks for those responses. So if anybody has any questions or comments, please put them in the chat box before we close for the day. I think we're good. So thank you, Sachin. Thanks for this very informative session. And thanks for taking out time on a Saturday evening for this. Thank you very much, Sachin, and thank you, Anupam. And thanks, participants, for being a part of this. And thanks, Lakshmi, for from Birth Venue to help us out with organizing this session. And we'll keep you updated on the next sessions that we host. We are also starting a change maker series, which will be more interactive, and there'll be more of storytelling on climate change practices that are coming up in the market. So we'll keep you posted on that. Thanks everyone, and thanks for being here today. Goodbye.
Thank you, Michelle. Thank you for having me.
Bye.
Bye-bye.